Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host here for about, I'm going to say 30 minutes today here on Options Guide TV. A recap of last week. We've gone back to the well 3 times in a row with the open wing butterfly, and I did say open wing. I didn't say broken. I said open, in that given us some downside, put butterfly, SPX, all of them worked out on Friday. If we made the adjustment, that worked out. We had a rally on Friday, but it kind of petered out at the end. I should say, from looking at the S&P 500 hourly chart, that everything kind of happened in 1 hour. And then there wasn't a lot of strength going into the end of the market, but the market's trying to hold. I really feel like the way the market is today, that the buyers and sellers are beating it out. And we have a major week this week because we have the Fed week on Wednesday. We're going to have a Fed meeting. The comments afterwards are going to be probably going to be the most important of the entire meeting. Highly unlikely that they're going to do anything. I think there was a 1% chance based off of the CME Fed Watch tool that the Fed would actually lower interest rates, and that was it. But if you go out to the next meeting, there's actually a 25% chance that they might cut. Right now, based off the futures, that's quite a ways away, but just the fact that it's pricing that in is interesting, I think, in general. The VIX is holding its own, even though we had a little bit of a rally last week. The VIX was kind of, I find the VIX interesting in that we increased on the downturn in the VIX, but we never got the, oh my gosh, look at the VIX moment, right? Where the VIX spiked up to 40 or 45. I kind of think it would have been a little nicer if we would have got that panic scenario. The market's panicking, but I guess I was looking forward to a panic a little bit more based off of all the headline news and everything that we had. So I don't know how to necessarily interpret that, because we're back down around the 20 level. And we're going to take the Fed meeting into account. So we've talked a lot about the butterflies and how they are cheaper when the VIX is higher, and the VIX is still high. We see the VIX trading right now at 21.23. The highest level was just below 30 before we started to sell off. And we had days, we're getting to a point of capitulation in my mind in the S&P 500 index. I would have liked to seen the bounce back rally stronger on Friday. We didn't quite get that bounce, that type of move to the upside. I think it is good that the news headlines didn't crash the market this weekend. And well, right now we're almost flat. So it's struggling. Here's the bottom line. The market's struggling. Until we get a breakout up above, we're quite a ways away from the 200-day moving average in the SPX. Same type of scenario in the NDX or the NASDAQ, QQQs, however you want to look at it as far as the chart is concerned. So I still want to get bearish. I still want to stay bearish. And as a matter of fact, I see that my trade has already moved against me because the market's starting to come back down. That simple. And I do believe that if we get a little bit of a rally in the market, we'll see a drop off in implied volatility on Wednesday after the Fed meeting. Like I said, well, once again, highly anticipated they're going to do nothing, but the comments afterwards are going to be big. Chairman Powell is going to be on the stage, and everybody's going to be sitting on his every word and there's going to get a lot of questions about what he thinks will happen with the tariffs, and we'll see if he comments on them. A lot of times he has declined to go there when it comes to talking about the tariffs and everything, and say that we'll react to whatever we need to react to. So very big meeting on Wednesday. But let's get straight to the trade that we have in the SPX. And then I got actually a bullish trade for you today too. So here's the SPX. Market's down. When I put the trade together, the market was at 56.55, and I bought just an out of the money put option to start our open wing butterfly, which we've done think we did 4 of them in a row. That all played out just fine. Well, obviously, if you look at the chart, we were bearish with these open wing butterflies over and over again. And if you look at the chart has done nothing but go down. Small little bounce back on Friday. So here, let's adjust it. I'm sad to say that I got to wipe out all of that work that I did before the show, and let's remove it. I'm going to do a Wednesday trade, and I think that's what's going to be a little bit different, because with butterflies, you want vol up when you put on the trade. It makes the butterfly cheaper. And you want vol to come off after the trade. The fact that implied volatility is higher right now usually is the fact that implied volatility is higher right now makes a general butterfly cheaper. You'd rather have implied volatility be high when you put it on and then come down afterwards. The VIX does react to the Fed meeting, and a lot of times you will see a little bit of an increase in implied volatility because of that meeting. So that might mean that even if we do get a downturn in the market, that the VIX could potentially come off a little bit. So we're going to take advantage of that. We're going to do the Wednesday expiration. The Fed, everything happens at around 2 o'clock on Wednesday. So I do expect implied volatility to come off a little bit, but we may drift lower heading into it. Market's really struggling, like I said, and it really struggled on Friday to get a foothold. It had one good hour in the marketplace on Friday, but after that, there really wasn't any continuation with that rally. So here we go. Here we're going to adjust it. We got to move down now, and now it's still going down. Now we're almost exactly flat. Okay, 56.44. I want to do the 56.40s. Go down 20 points to the 56.20s. Sell 2 of those, and then we only go down 15 points from there to 56.05, and we buy that one. All right. Yeah, see, that's not bad at all. 260 is where we were. Now 285. I'll leave it at 285. Let's call it 285. That's from moving fast, but all right. So that's the official paper trade right there. Send it to the what if calculator. It's going to pop us over there, and then we're going to have to come back. All right. So here's the trade. We're going to do the Wednesday, March 20th expiration, Fed day. And we see that over here. We confirm we're going to be on the put side of the options grid. So we're over here. We're going to go just out of the money, and we're going to buy the 56.40 strike put. We're going to then go down 20 points. And we're going to sell 2 of the 56.20s. We're going to sell 2 of those, and then we're going to go down 15 points, and we're going to buy one of these. Now, as opposed to buying these options outright, look at the cost, right? $48, $39, $34. We can get this whole thing done for $2.85, $285. That means that's our max risk for the trade is $285. The most that it could trade for is $20, the difference between the strikes. And let's be realistic, you're not going to get that. That means that it would go out right at 56.20, right at the expiration date. So if you're doing this trade, a doubler is great. Even if the market goes this direction, this isn't a home run trade. You're just looking to double or maybe a little bit better and get out. And also, because it's open winged, in other words, we're opening the bottom wing in this scenario. If the market goes below 56.05, you are profitable on the trade. And that's very easy to see if we look at the what if calculator. So let me pull the what if calculator back up. Zoom in just a little bit on this trade because we did adjust it. All right. Let's reset this. Yeah, go there. Okay. So this is what we paid for it. It looks like it took the price of 280, and your eyes have to focus over here. That's where it's showing you that. So that's what it's saying our max loss is $2.80. We said we got it done for $2.85 based off of where the market was when we first started talking about it. Now, on this end, if the market goes down once again and vol comes in, well, ultimately the green line will start looking like the yellow line as expiration approaches. If it blows through our strike to the downside, we would be up, according to the what if calculator, $220. That's based off of a $280 fill, because the butterfly would be trading for $5. Where did the $5 come from? It's the difference between the long put spread and the short put spread, the width of the strikes that make up the butterfly. So you have a long put spread, which is 56.40 down to 56.20. That's 20 points. And then you have a short put spread, which is the other spread inside the butterfly that makes it up. And that goes from 56.20 down to 56.05, which is only 15 points. Once again, it's got to trade for 5. You paid 280 according to the what if calculator right here. That means that you have $220 here that you can make if it blows through your strike. So you almost double if that just happens there. Now, anywhere in the middle, shoot, we're doing good, right? So even if the market goes all the way down, there's not necessarily a to be scared if it's going to come back up, right? And one of the wonderful things about the S&P 500 index is that it's a cash settled index. So if the market goes down, you can't be assigned early. There's no early exercise in the scenario with the S&P 500 index, and it's cash settled. So all that happens is your options go away and there's new cash in your account. Now, if the market goes up, you have the risk. You can lose this amount, $2.85 or $285, and you know that. That's the maximum that you can lose. So the market's got to go down. It's got to go in your direction, heading into that Fed meeting. You're going to get a lot of time decay. Obviously, the after the Fed meeting, you're going to be at the end of the day. You're going to have implied volatility probably come off a little bit, and you're going to have a huge amount of time decay. The fact that we can do this trade for $2.85, or now it's even a little lower, $285 per 1x2x1 butterfly, is 100% because the VIX is still trading north of 20. And without that, this would be probably trading for 310, 315 on a 2-day butterfly, maybe even 350 if we were down around the 15 level in the VIX. Or just, the VIX is a 30-day volatility. Here we're only talking about 3 days. We got, well, I guess I can actually just point to it, right? The IV is at 24% right now on that March 20 option contract. So the shorter term options and everything, I guess, is fairly steady. You see this one is a little higher than this one, right? So you have the IV here around 24, down here is around 22.5. Why do you think that is? Because the Fed meets on the 20th, and that's why it is. And that's why we're focusing on these option contracts, and we're not going to go out the entire week. That also means that if the market does go up today, if it bounces back, and now it's back up to 56.50, where I started the day, or where I initially set up my trade, and if the market ends up 1%, we've got to decide if we want to adjust this trade. I kind of feel like with the Fed meeting on Wednesday that we don't want the risk of the adjustment. So it's going to take a while for me to consider if the market did go up 1% tomorrow or a little bit more, if I would want to adjust the trade. But we've talked about many of the other trades that you put this trade on, market goes against you, you sell the most expensive one, the 56.40, and you buy a 56.20. And that leaves you in a short put spread, and you flip the script and you get bullish on that trade. And that's the way that it would be if we did that trade. So $2.85. Oh, we got some comments. There we are. Sorry, I keep forgetting to look over to my right. You said Wednesday, but you're on Thursday quotes. Thursday is March 20th. Oh man. then why? You're right. Doggone it, Fresh Prince. I apologize. But why is the vol so much different on the 21st than the 23rd? Oh, we're over here. We're at 25 on it. All right, let's see where we can get it done for. 285 is a good price. Let's flip it. Let's flip it. Thank you for that. On it. And here's the main reason why I want to do the Wednesday quote. The 19th, yeah, double checking, is because you do want the volatility crunch. So 56.50. Okay, so we're going to go 45. Buy that one. Let's go 20 points down. Sell this one. And let's go 15 points down and buy that one. And that is 15, and that is 20. Yeah, and we're still at 280. That's interesting. and a lot to do because I get it's not much though. The difference in vol isn't really huge, but there's a big drop off from the 3rd to the 4th. I guess I just looked at the vols and assumed this was the Wednesday. No need for excuses. Interesting to see that this is trading March 19th. Okay, I didn't screw that up. That it's trading for the same price almost. Market's at 56.52, and we even moved it up a little bit. So now it's 53. So now we're 8 points out of the money. You could bring it up to this one if you wanted to, 56.50. I'm going to leave it here just for sake because we're getting a little long today. So 22.80. I'll send this to the what if calculator, and I'll make sure that that is the trade that I take the screenshot of. And we see a very similar graph here, right? Okay. Now, interesting chart in AMD, and I have to admit I found this by watching some videos this weekend, but I want to get bullish on AMD. And here is a longer dated chart, and we see this area of resistance before AMD took off at a nice high here, right? Here's the 200-day moving average. We've really got overextended on the 200-day. So right here, there was a lot of noise. The 20-day, it's hard to see a little bit, but the 20-day and the 50-day, we had what's called a death cross here. Stock has gone straight down. MU is announcing earnings this week, and that could have an effect on AMD a little bit. But really like this area right here. And we're getting a little bit of a follow through here on AMD. So let's zoom in a little bit and grab this little corner here. All right, so we're bouncing up. We've got the potential to close above the 200-day moving average. Area of support was down here, and look at all the noise that's here. It didn't want to go below that level at all. Today we're showing some strength. 20-day moving average here, 50-day here, and quite a bit. How many points is that from? We're 35 points below, almost, that's about 35%, the 200-day moving average. So yeah, quite a bit overextended in this scenario, and just an interesting trade. So it's hard to find something that you'd want to get bullish on. Micron Technology is announcing earnings this week, and that's going to have a little bit of an effect on it. But I did like the trade, so I wasn't going to just leave you just with a SPX trade this week. Let's look at AMD. And in this scenario, you can do one of two things. You can either do a short-term trade and straddle the market, or we can go a little bit longer and we can do a longer bull call spread. And once again, Options Guide TV is all about learning. So if I go wide on my bull call spreads, like 30 points, right, all the way back up, maybe, you're targeting something closer to the 200-day moving average. So this extends down a little bit, right in this range, 135 or so, looking for a strong move to the upside. Here's one of the things that I like about going wide on a bull call spread is that if you're 30 points wide and the market does go up, you can sell your long option and roll it up and make your spread 15 points wide. So you're still getting the benefit of the time decay on the longer term option contract, but you will get a move up in you can capture some gain on your long term and let that way out of the money option contract decay. And so I kind of like that trade, and I'm going to leave it and I'm going to throw it into the notepad over here, and we will follow it. And I mainly want to do that type of strategy because of the adjustments. I think adjustments are one of the biggest things that you can talk about on a live event show if you get that opportunity to adjust. Because adjustments, like even in my book, probably one of the most comments inside Amazon is there's not a lot of talk about adjustments. I talk about adjusting a covered call position, rolling a covered call position, rolling a put position, but it's really hard to talk about adjustments and not be in the middle of the adjustment, because there's no if this happens, then this, then that, then this. It's hard to say without looking at live markets when exactly you should adjust. That simple. We'll leave it there. Okay, so we're going to go out 31 days. We're going to go out to the April 17th expiration. We're going to go a little bit in the money here. So that's 31 days out, April 17th expiration. Market is at 105. We're going to stay on the call side of things. All right, we caught up. 130, I think, is a range, but we can get more for the 125 strike call here on AMD. Now let's go one standard deviation. Let's go to the 120. So that gives us 15 points. So we could roll to the one. I think we want to do 125. All right. So here's our option. Here's our option contract that we're going to buy. We're going to look at buying the 105 strike call. Let's clear this out. I'm going to go 30 days. Keep that there. Just one. Okay. And then we're going to sell the 125 strike call. Okay. I need to be patient here. My computer always moves slow when we're running the video. And then we're going to sell this. Okay. 125. We'll sell this. And so in this scenario, if the market goes up, we're buying this $8 option contract. We got a 70 delta, and let's say we move up 5 points. We move up to the 110. We can easily sell this and move this up 5 points, or we can move it up 10 points. Whatever we want to do in that scenario. But if we do get an additional 5-point movement to the upside, it's okay to take profits on this and let this one wither away. This will have a large rate of time decay because we are more than one standard deviation move out of the money. We're getting 42% in the implied volatility range. If we can buy this back for a dime and bring this in even a little bit, we're okay. So here's the scenario. Market goes up. You roll this from 100 up to 105. Time decay starts happening. You roll this down from 125 down to 120. You pull the spread in, but you take profit on your short option contract and you take profit on your long option contract. Now, the market's got to go up, right? if the market goes down, well, then you're out of luck. But we're paying $7 and 1 second. Paying $7.76 for this trade, knowing that we can probably adjust this trade if we are down and we end up losing half of this value. I'd say around $3 is where I would look to get out of the trade. And now the only other thing that you can do, but you're only saving about 50 cents if you want to do, I don't want the cheese anymore, just let me out of the trap, is to pull this all the way down. Say the market goes down to 190, you can close this and maybe sell the 110 and try to get rid of some of the risk. And that allows you to stay in the trade a little bit longer. So that's a different adjustment. I don't like that adjustment as much as if we are correct and we roll it up and then we pull this one down a little bit after we get some time decay. But on the way down, the other adjustment, you can only make 52 cents on this. You can't do any better than that. So if your adjustment would be to try to capture, 45 cents of it and roll it down and get another, I don't know, maybe 75 cents or so by rolling down and pulling the spread in, making it tight, still allowing you to get profitable if the market comes back. But that would be the scenario. So I'm going to send this one to the what if calculator. We'll call it let's go 770 because we're going to be looking at this trade for some time. So that will be our midpoint 772. We've seen it dancing around. Now, no guarantee a midpoint fills. SPX is pretty good, especially when you got multiple legs. AMD is fairly liquid, fairly good volume, fairly good open interest. I think we could trade somewhere near that midpoint, but never a guarantee. And I just want to be realistic about that. I don't think I say that enough on here on Options Guy TV. And send it to the what if. Okay, there we go. Pull it down. We're a little bit in the money. Market is right here. Our strike is the 100, giving ourselves a lot of room to run up to 125. Looking at the chart, that's a very feasible type move. Strong move going back towards that 200-day moving average. And it'll be a big deal if we end up basically right where we're at right now, just from looking at the chart, pulling this area in. And we can finish above that 200-day moving average with a little bit of momentum. That would be a solid move. Like here we came up above the 200-day moving average. Didn't have the strong support in this area right here. But closed down, another one, closed down. It's harder and harder the more times it touches it for it to not break out. And we've had quite a few touches on the way down through this channel. I like it. I like it. I like it. That's simple. All right, everyone. Any other questions? I think that is it. Yep, I think that's going to be it for this edition of Options Guy TV. Please sign up on hub.tradier.com. If you'd like to ask questions, you can do it directly through that platform. Also, Tradier YouTube channel. Follow me on x.com. My handle is @BrianOverby. And you can stream. You can also watch these videos via the x.com platform, my profile, or the Tradier profile. Thanks for stopping in, and we'll see you this Wednesday for Fed Day on Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.